Hello, friends. Welcome to learning sessions and good evening to all of you. And this is the 30th session for the BFM CAIIB, and we are covering the module A. I hope that you must have gone through the previous sessions. We are covering the chapter related to the facilities for the exporters and importers. We covered related to the post-shipment finance so far in Indian rupee. And the next topic that we are going to cover today, it's about the post-shipment export finance in the foreign currency. We'll be learning about the EBR, we'll be learning about the refinance facility, we'll be learning about the gold card scheme for the exporters and much more. So make sure to watch this video till end, right? And if you're having any queries related to the course, related to the materials, do WhatsApp us at the number 83609 And if you want to get the PDF files of the session, you just simply need to download the application, which is iibf.info/app. And further, after downloading the application, if you are iOS user, you need to enter the ORG code, which is GEGKT. And then you can be enrolling into the course of CIB Early Bird Pack, where we'll be providing you with the full course videos, case study videos, chapter-wise previous year questions, mock test, mega test, and the PDF notes, which are downloadable as well as printable. So, let's start the session over here now. It's related to the post-shipment export finance in the foreign currency. Now, as I told you, definitely it is allowed that the post-shipment finance can also be given in the foreign currency. That can also be allowed. And what funds can be used by the banks? It could be a line of credit from the bank abroad. It could be line of credit from the domestic bank. It could be like funds which are there in the EEFC account or DD accounts, or let's say in the RFC account that can be used. So the first thing that we are covering over here, it's related to the EBR. Now, what is EBR? It is rediscounting export bills abroad. It's a RBI scheme for the post-shipment foreign currency export credit, right? So EBR is what? It is export bill rediscounting, and it is basically post-shipment working capital credit facility. So let's say the case that here we are having the exporter who has drawn the bills on the importer, and those bills have been accepted, and the exporter is having the bills now. Now these are the bills which have not been realized so far. These could be the demand bills, or these could be the usage bills. Now these bills can be rediscounted, and further these bills can be rediscounted by the exporter, right? So first of all, the discounting will be done by the exporter. So exporter will be discounting them with the bank, and the bank will be providing them with the funds, right? So it's a working capital credit facility which will be available in the foreign currency to the exporters, and this is Reserve Bank of India regulated scheme. And further, banks and financial institutions do provide the foreign currency advances against the export bills, right? So they will be providing the foreign currency advances against the export bills. Clear with it? So post shipment credit, it is foreign currency denomination. It can be under in any of the convertible currencies, like it could be USD, it could be Euro, it could be GBP, it could be Japanese yen. And as I told you, the banks are going to utilize the funds which are lying in their EFC accounts, in the RFC accounts, or it could be the case that they are having a line of credit from the banks abroad, or line of credit from the domestic banks. And further, it's also allowed to the banks that they can be rediscounting export bills abroad. Now, the bills which have been discounted. Now, the first scenario when the exporter is going to the bank for the discounting purposes, it is said to be discounting of the bill. This is simply said to be the discounting of the bill, right? But thereafter, the banks can also get it discounted from the banks abroad, from the institutions abroad. Let's say we are having the bank abroad, and further bank further get discounted these bills. Now the credit risk will be lying with the bank, but the rediscounting will be giving a facility foreign currency to the exporters bank, to the exporter banks, that will be available, right? And further, banks may be arranging a bankers acceptance facility for rediscounting export bills. Now what is bankers acceptance facility? Any idea related to it? The bankers acceptance facility. So what is BAF, or simply BA? It is basically a time draft, or let's say in case of the usage bill of exchange that has been actually been accepted by the bank, right? Now the bank can be getting it basically financed again from some other bank, right? So that is basically you'll be getting some acceptance facility. You'll be getting some acceptance facility. So the bank has discounted the usage bill, and now the bank is having the usage bill which is assigned to the bank, and bank is further rediscounting that particular USAIN's bill from the bank abroad. So the facility now which will be available to this particular bank, that will be the banker acceptance facility. Clear with it? And further, each bank can be having their own BAF limit with the overseas bank. Like they can be having their own limit with the overseas bank or the rediscounting agency or the arrangement with the agency. Like, right, let's say some factoring agency, it could be the case. So each bank may be having their own specific limit that we say to be the BAF limit. Like bank A is having a limit of 10,000 crores, or let's say 1,000 crore or 5,500 crore. So the different banks may be having the different limit related to it. And further, the exporters can also be arranging this limit themselves. Like they can be getting this line of credit from the overseas bank themselves, right? Or through some other agency. Let's say there will be no Indian bank in between, and the exporter will itself be arranging a line of credit from the bank abroad. So they will be getting the bill discounted directly from the bank abroad, and further they will be getting the foreign currency for the same. So bill discounting will be done directly from the bank abroad, and further they will be getting the foreign currency for the same, right? And this is said to be line of credit from the bank abroad. Now, what is the eligibility criteria for the EBR scheme? What is the eligibility criteria? Now, the scheme is going to cover the export bills which are USAIN's, where the USAIN's period is up to 180 days from the date of shipment. So if the USAIN's period is up to 180 days, we are talking about the USAIN's period, means the credit period we are talking about. So if the USAIN's period is up to 180 days from the date of shipment, inclusive of the normal transit period, that is NTB. I've already given you the definition related to NTB. Reiterating the same, it is a period from the particular date of negotiation of the documents between the beneficiary and the negotiated bank till the amount is credited to the nominated bank. That's basically period is said to be what? That is said to be the NTP period. So this 180 days is basically inclusive of NTP period. And let's say the case if the person or the borrower is basically allowed, not borrower, we are basically meant to say exporter over here. Exporter who is going to borrow the money, right? So if in the case the borrower is eligible so as to draw the USAIN's bills for the period exceeding 180 days as per the extent instructions of the FED, as per the instructions of the FED, post shipment credit under the EBR scheme can be provided beyond 180 days also. So in general, we can say the time limit is 180 days for which the EBR scheme is allowed. But in case if the exporter is allowed that they can be, drawing the bills exceeding 180 days, in that scenario, further beyond the 180 days period, the EBR scheme will also be available. And the facility under the scheme of rediscounting may be offered in any of the convertible currency. Like I told you, it may be GBP, it may be Japanese yen, it may be Euro, it could be anything, right? Further, it's related to refinance. So banks are actually not eligible for the refinance from the Reserve Bank of India against the export bills, discounted, rediscounted under the scheme. So if the bills are discounted or rediscounted under the EBR scheme, in that scenario, the banks won't be eligible for the refinance from the Reserve Bank of India. Clear with it? Now, after that, we are going to learn about the gold card scheme for the exporters. It's a special scheme which is available for the status holder exporters, the exporters which are having a proven track record for the previous years. Those are provided with this particular scheme. Now, the gold card scheme was introduced by whom? It was introduced by the Reserve Bank of India, so as to ensure that the simplified, faster, and need-based export credit is available to the credit-worthy exporters. Now, we wanted to reduce the procedural delays. Now, there are so many procedures which are to be followed. So, we wanted to reduce the procedural delays. We wanted to provide the better credit limits. We wanted to provide the concessional rate of interest and flexible credit facilities. That's the main thing related to that the gold card is issued. Now, what is a satisfactory track record? So normally it is required that the exporters must be having satisfactory track record for the previous 3 years. They should be having a very good track record for the previous 3 years. And further, their export accounts must be classified the standard account, and there should be no adverse feature in their credit history. And further, the export business must be of reasonable size. Now, if these conditions are there, like what if the exporter is credit worthy, and further let's say case we are talking about the eligibility criteria, right? So exporter must be credit worthy, and further the exporter must be having a good track record for the past 3 years. And further, let's say the scheme will not be applicable on those particular exporters which are blacklisted or which are under the caution list, or where the overdue bills are in excess of 10% of the previous year turnover. So let's say your previous year turnover was 100 crore and your overdue bills are over and above 10 crore rupees. That's more than 10% of the total bills which were drawn in the previous year. So in that case, you won't be eligible. So this is a criteria which basically won't be allowing you to be a part of the gold card scheme, which won't be allowing you for the gold card scheme. And even if you are related to small and medium sector, now if you'll be satisfying the laid down criteria, you will be eligible for the gold card scheme. Now, what are the different features related to the gold card scheme? Now, gold card holder exporters, right? Depending upon the track record, depending upon the credit worthiness, they will be allowed with they will be granted with the better terms and conditions for the credit purposes. Like the rate of interest which will be extended to them, those will be lower, like lower rate of interest will be charged to them as compared to the other exporters by the bank. Let's say if the other general exporters are charged 7.85%, they are charged 7.7% or even lower than that, right? So comparable rate of interest will be lower. That's the first benefit. The second benefit is it is that their applications will be processed in a very faster manner. So the process will be faster for them. And further, the norms will be simpler for them. So that's the second benefit. The first benefit is related to rate of interest. The second benefit is related to the processing speed and also related to the simpler norms, and also the charges which will be charged to them, or the fee structure which is to be charged to them in lieu of the services which are provided to them. Those will be lesser as compared to, those will be lower as compared to the charges which are basically imposed on other exporters. And also for the sanction and the renewal of the limits, there will be simplified procedures. So simplified procedures for the sanction and the renewal purposes, that's the fourth benefit. And in principal limits which will be sanctioned to them, that will be for at least a period of 3 years, and there will be automatic renewal if the terms and conditions are fulfilled. So automatic renewal at the end of the year if the terms and conditions are fulfilled. So that's the fifth benefit which will be available to them. And the sixth benefit, that's related to standby limit, very much important. Standby limit of not less than 20%. Let's say if in principal limit is sanctioned rupees 4 crore, then a standby limit of 80 lakh rupees will be sanctioned to you. Additionally, that will be sanctioned to you. So that if there is any urgent requirement or credit need at your end, let's say if you're having certain orders or something, right? In that scenario, you will be having that particular limit with you, where you can be debiting the account and further can be fulfilling the orders, right? So standby limit of not less than 20% will be given to you. And let's say if you're having any of the unanticipated export orders, you're not basically looking for the orders, but you got the orders, then the inventory norms are also relaxed for such exporters. The inventory norms are very much relaxed, and the request from the card holders would be processed quickly. Like it will be for fresh applications, the applications will be processed in 25 days. The renewal of limits will be processed in 15 days. And if the ad hoc limits are to be sanctioned, if any, those will be sanctioned in just 7 days, right? So the time period is also reduced. The processing is very much faster and simpler norms will be there. For application, it is 25 days. For renewal, it is 15 days. And for ad hoc limits, it is 7 days, right? And even if the banking credit limit in foreign currency is to be given, right, the gold card holders will be given a priority over the other exporters. Those will be given a priority over the other exporters. So the that's basically related to the benefit number 9 that's available to the gold card holders. And the 10th, it's related to that if you're looking for the ECGC guarantee scheme, if you are looking for the ECGC guarantee scheme for the gold card holders, so banks can be considering waiver of the collaterals for exemption of the ECGC guarantee scheme even, right? If you are having a better track record, a very good credit worthiness, so bank won't be asking for the ECGC guarantee. Bank won't be asking you for the collateral purposes or something like that. And there is a value addition. The banks can be offering you additional benefit like internet banking, like the ATM card can be offered to you so that you can be debiting or crediting from any point, right? Or international debit or credit cards may be issued to you. And let's say if you're having a very good track record and for the there are no overdue export bills in your name or very lesser overdue bills in your name, then definitely you can be issued the foreign currency credit cards. The foreign currency credit cards can also be issued, right? This is again a very important point. And further, banks may ensure that the PCFC requirement for the gold card holders are met by giving them priority. So let's say if you want the PCFC, that is packing credit in foreign currency, you will be given a priority related to it. Even if you want the post shipment finance in foreign currency, you'll be given a priority over it. And further, the banks will consider granting term loans in foreign currency, term loans in foreign currency which are generally not given, so you'll be also be given a priority over the same, right? So these are the 14 benefits which will be available to the gold card holder. The first benefit is related to better credit terms. Now better credit terms if you're having a good very good track record. The second, it's related to the process will be simpler, the norms will be simpler, and the process will be faster. And the third, it's related to lesser charges and fee structure. And fourth one, it's related to sanction and renewal will be easier, and in principal limit will be sanctioned for a period of 3 years, and automatic renewal will be there if the terms and conditions are met up. A standby limit not less than 20% which will be issued to you, and for unanticipated order there will be relaxed inventory norms. And further, the request will be processed very much faster way, like application will be processed in just 25 days maximum, and renewal in 15 days, and ad hoc limits in just 7 days. And further, the gold card holders will be given a preference related to packing credit limit in foreign currency, related to post shipment finance in foreign currency, and there can be a waiver related to ECGC guarantee related to collateral also. And the valuation is related to that will be giving the supplementary services like ATM or internet banking. You will be given a foreign currency credit card or debit card can be issued to you, and also PCFC requirement for the gold card holders, as I already told you. And foreign currency term loans can also be sanctioned to you, right? So these are the benefits which will be available to the gold card holders here, right? Is that clear? Are you clear with these points? So that's the that's basically related to the all benefits which will be available to the gold card holders, right? So if I have understood the part so far, make sure to like this video, and further do share this video among your friends and colleagues who are preparing for the CIB exam. And if you want to get the complete PDF of the sessions, then you simply just need to WhatsApp CAIIB to the number 83609 44207, and I'll be sharing all the details with you. Right now, let's move further. It's about the next scheme, which is IES. Now, what is IES? IES is Interest Equalization Scheme. It is interest equalization scheme which will be available for the pre-shipment finance and the post-shipment rupee finance. Post-shipment rupee finance. So it's just related to that you will be given a interest subvention or interest subsidy will be available to the exporters, so that the loan can be provided at the very competitive rate. So it's related to the interest subsidy which will be available to the exporters, which will be available to the exporters for the pre-shipment finance and the post-shipment finance in Indian currency. So what is the main objective of the same? That we want to provide competitive rate of interest to the Indian exporters, and so as to reduce the cost of the working capital. And also we want to support the MSME and the specified export sectors, because this is primarily available for the MSME exporters, and also the specified 410 tariff lines like related to non-MSME manufacturers and exporters. This facility is also available. Now, in case of MSME exporters, the subvention which will be available, the interest subsidy which is available, that is 3%. And for non-MSME exporters, the subvention which is available is of quantum of 2%, and it covers both of the facilities, like it covers the pre-shipment finance as also the post-shipment finance, right? And the maximum benefit that can be availed, or the ceiling for let's say per exporter per year, the limit is 50 crore rupees. So the maximum subvention, maximum interest subsidy which can be provided to you, which can be provided to you, for which the interest subsidy can be provided to you, the exposure could be up to the amount of 50 crore rupees, for which the subsidy will be available to you, not more than that, right? And further, about the realization period condition. Now, the condition is related to that whatsoever the export is being done, Whatsoever the export is being done by the exporter, the payments must be realized within a period of 9 months. Only then this particular scheme benefit would be available. And if the proceeds are not realized within the prescribed period of 9 months, then interest equalization scheme benefit will be reversed, and penal interest can also be charged. Penal interest can also be charged. And what are the conditions related to it? Like in respect of MSME, it is 3%, and for non-manufacturing it is 2% now it is changed. This particular criteria is now changed, right? And further, whatsoever the benefit related to the interest subsidies, that will be transferred upfront by the banks, and further the banks may be getting the reimbursement on the monthly basis. The banks can be getting the reimbursement on the monthly basis, and further the reimbursement claim will be made when the funds are received from the government. Those will be settled. Those will be settled with the banks. Now, what is the criteria related to the exporters? Now, the banks, first of all, the exporters must be having the IEC number, a valid IEC number. This is the criteria. Now, IEC is what? This is import export number, right? Import export code number, and it is issued by the DGFT, Directorate General of Foreign Trade. It is issued by, that must be there, right? That's the first condition related to it. A valid IEC code must be there, and standard account must be there. The account should not be non-performing. It should be a standard account, right? And export goods must be falling for the eligible tariff line. Let's say for non-MSME we are talking about, the export goods must be falling under the eligible tariff lines, and further they should be providing the undertaking confirming the eligibility. Undertaking is to be given. So the fourth one, we can say it's an undertaking that must be given. So these are the eligibility guidelines we can say, right? So let's say case MSME exporter is charged a rate of interest of 9%, and a subsidy of 3% is provided. So the net rate of interest, the effective rate of interest which will be charged to the exporter will be 6% here. It will be 6% here. Clear with it? Kindly do confirm. Now, that's basically all related to the guidelines for the exporters so far. Guidelines for the exporters so far. And the next topic that we are going to cover is related to the guidelines for the importers. Now, importers are those which are going to import the goods or the services, and further they are to make the payment for the particular import, right? And the regulatory framework for the importers, if you're talking about the regulatory framework for the importers, what is the regulatory framework? It is again the FEMA. It is again the FEMA, that is Foreign Exchange Management Act. It's the RBI master directions, or simply the RBI directions which are given by the Reserve Bank of India related to the import of goods and services. The Customs is Act is available. The Customs Act is available, and DGFT Foreign Trade Policy, that is FTP. So the regulations on importers are based upon FEMA, based upon the Reserve Bank of India guidelines, based upon the Customs Act, and based upon the Foreign Trade Policy by the DGFT, right? So every importer must be having the IEC code. IEC number must be there with the importer. That's the very first thing which is required. And further, they are to open a current account with the authorized dealer bank. So a valid current account with the authorized dealer bank, that must be there, and they are to comply with the KYC norms. The KYC norms must be complied with, and they are to provide the permanent account number, means PAN number must be available. So these are the guidelines for the importers. So no remittance will be permitted if they are not having the IEC code with them. No import will be permitted in that scenario. Let's have a look at the theoretical part. So physical movement of goods into India basically is regulated by the foreign trade policy, and also the EXIM policy, basically, which is formulated by the DGFT. And the regulations which will be available, those that's basically related to the FEMA, that's related to the Customs Act, that will be applicable. And every importer must be having the importer exporter code number. That's basically required to be, that is a must one. PAN number, KYC norms, IEC number, that's a must one, right? And further, if we're talking about the approved commodity, if we are talking about the approved commodity, then basically there must be the commodity which you are importing. the commodity which we are importing, that must be approved one, or let's say that must be, we must be having the import license for the same. Let's say, or we must be having the open general license. We must be having the open general license. Now, what is open general license? Open general license is basically referring to the goods which can be imported, right, freely without obtaining a specific import license. For that particular scenario, you should not be having the import license, but in case if it is required, you should be having the import license. So OGL is related to what? OGL is related to open general license. Let me write over here. So OGL is related to the open general license. So that must be there. Clear? So it must be, it's a required thing that you should be having, either it should be under OGL or you should be having the import license for the same. And further, license will be issued by one, by whom? It will be issued by the DGFT as per the FTP, foreign trade policy. And if we're talking about the payment for the imports, if we are talking about the payment for the imports, right? So any person who wants to make a remittance for the exports, for the imports, which is exceeding 500 USD or equivalent, the application must be given as prescribed by the Reserve Bank of India to the authorized dealer. So through the authorized dealer only the payment can be made. The remittance can be made if you're going to make the payment for the imports exceeding the amount of 500 USD. The application as prescribed by the Reserve Bank of India, that should be made to the authorized dealer. To the authorized dealer. And what is the time limit for the import payment? Anyone? What is the time limit for the import payment? Now, if you're going to import, there is a time limit for the payment, na? And what is it? It is 6 months from the date of shipment. It is 6 months from the date of shipment when the shipment has been made. So you should be completing the payment not later than 6 months from the date of shipment. And if there is any delay, that should be justified with proper explanation that what is the reason for the payment delay. And if the payment is to be made in deferred payment arrangement, let's say the payment is to be made for the capital goods and that's basically beyond the 6 months, right? So that will be treated as a trade credit. So in that scenario, that will be treated as a trade credit, right? So let's say case that if you have to, otherwise you have to make the payment for the import in the period of 6 months. And if there is delay, that should be explained properly. And further, in the case of the deferred payment arrangement, if it is beyond 6 months period, then it will be treated as a trade credit up to the period of 3 years. Now, if it is greater than 6 months, if the deferred payment arrangement is greater than 6 months, but is up to 3 years, then it will be treated as what? It will be treated as a trade credit, right? Then it is related to the advance remittances by the importer. Now, are the importers allowed that they can be making the advance payments? That they can be making the advance payments? Yes, they are allowed. Yes, those are allowed. They can be making a advance remittance for the import purposes, right? And further, in that scenario, the IEC required, the KYC is required, the proforma invoice is required, the undertaking is required, right? Those all things are required. And if the advance payment or remittance is exceeding 2 lakh USDs, if the advance remittance is exceeding 2 lakh USD per transaction, then definitely bank may be requiring a bank guarantee or standby LC from the internationally reputed bank, right? So where the amount is exceeding 2 lakh USD, in that particular scenario, you do require a irrevocable standby letter of credit or bank guarantee is basically required from the bank of the international repute that is situated outside India. That's basically required in that scenario. If the where the amount of advance for the services is exceeding 5 lakh USD, and for the goods if it is exceeding 2 lakh USD. For the goods previously the limit was 1 lakh USD, but now it is 2 lakh USD or equivalent to it. For services still it is 5 lakh USD. For services still it is 5 lakh USD, right? And further, the requirement of guarantee cannot be insisted upon in case remittance is above 1 lakh USD and up to 50 million USD, subject to a suitable policies approved by the bank's board of directors. So it cannot be insisted upon if there is a board approved policy, right? So as to undertake such particular transaction, and further there is a board approved policy, then it cannot be insisted upon. Then such guarantee cannot be insisted upon. And all the cases beyond 50 million USDs, beyond, not 50 million, actually it is 5 million. Sorry, it is 5 million. My bad. It is 5 million. It means 50 lakh USDs. Means 50 lakh USDs, right? So remittances above 2 lakh USDs and up to the amount of 5 million USDs, subject to a suitable policy, it cannot be insisted upon, right? And all the cases beyond 5 million USD, if there is any case which is beyond 5 million USD, that should be referred to the Reserve Bank of India for the approval purposes, right? And further, the importer hold exchange control copy of valid import license. That must be there. That must be there. Like if you are not having the OGL items, then you must be having a valid import license, and that should not be under the negative list. That is basically not allowed. You cannot be making advance payment for the same. And remittance is to be made directly to the overseas supplier or its bank and not to the agent. You cannot be making a advance payment to the agent or the agent of the supplier, right? You are to make payment directly to the supplier, overseas supplier, or directly to the supplier's bank, but not to the agent of the supplier. And physical import into the India should be made within a 6 months period. In case if those are capital goods, then the maximum period which is allowed in which the particular, let's say, the import is to be made is 3 years, but in general it is it is basically 6 months. So from the date of remittance, within the period of 6 months, the import must be there. The import must be there, and an undertaking is to be given by the importer that the documentary evidence is to be given. Documentary evidence is to be given within the close of the particular half year. In 15 days, a documentary evidence will be given that the, let's say, bill of entry will be there, right? So importer is to submit the bill of entry. And further, now this period is basically reduced to 3 months. Now this is basically reduced to 3 months. Now it is not 6 months, it is 3 months. That within 3 months, the import must be made. The import must be made. But for capital goods, it is still 3 years. The maximum period is basically allowed to be 3 years, right? And in case if there is no import of the goods and you have made the advance remittance, so it should be taken care, and the authorized dealer bank is to ensure that the advance remittance is repatriated to India, that the advance remittance is repatriated into India or is utilized for any other purposes which are permissible under the guidelines, right? So these are the important points. So let's rediscuss them. So first of all, if the amount of the advance remittance is up to 2 lakh USDs, right? If the amount of the particular remittance is up to 2 lakh USDs, then no issues about it. You can be having the authorized dealers to get themselves satisfied about that particular transaction. That's it. And where the amount of advance remittance for the services exceeds 5 lakh USDs, or for the physical import, if it exceeds 2 lakh USDs, right? In that particular scenario, what is to be done? A irrevocable standby letter of credit or the bank guarantee from the bank international repute is to be get available, right? And further, the requirement related to the guarantee cannot be insisted upon the cases where the remittance, advance remittance is above 2 lakh USDs and up to 5 million USDs, where there a suitable board of directors approved policy is there, right? And all the cases which are beyond 5 million USDs, those should be referred to the Reserve Bank of India and prior approval is to be taken. And further, the importers must be providing the exchange control copy of a valid import license. Let's say if you are not importing under the OGL, and items from the negative list should not be there. And remittance is to be made directly to the supplier or the bank of or the supplier, but not to the agent of the supplier. And physical imports in India must be made within a period of 3 months. That must be made within a period of 3 months. And in case of capital goods, it is 3 years from the date of remittance by the importer. And for the importer is to give an undertaking, the importer is to give an undertaking that the supporting documentary evidence will be submitted. It will be submitted within 15 days from the close of the relevant period, right? And in case if there was non-import of the goods into India, then definitely the authorized dealer bank must be ensuring that the advance remittance is repatriated to the India bank, or it is utilized as per the extent guidelines or the rules or regulations. Clear with it? After that, it's related to the evidence of imports. The next topic that we are going to cover here, it's related to the evidence of import. Now, what do you mean by evidence of import? Now, whatsoever the things that you are going to import, goods or services you are going to import, you are to give an evidence for the same that the goods have been imported into India. So it is mandatory for the importers who has to submit the evidence under the FEMA Act, under the RBI directions, under the Customs Act. It is very much required. The first document, the very much important document is BOE. BOE, that is Bill of Entry. And this is a principal documentary proof, which is issued by the Customs Authority, right? Now, when the customs are basically confirming that the goods are imported, means confirmed. And this is filed electronically through the ICE Gate. ICE Gate is a customs software, right? And further, it is matched with the remittance details in IDPMS. So there is a system which is IDPMS, So details will be available under the BOE by the ICE Gate, and further it is to be confirmed with the details under the IDPMS. That's the whole part. So that's the whole part. And what is the time limit for submission for the bill of entry? It is 3 months. So bill of entry must be submitted within a period of 3 months. So there is a time limit of 3 months under which the bill of entry is to be submitted, right? And further, if it is not submitted within a period of 3 months, then the bank should be following up. And further, the transaction is going to remain outstanding in IDPMS. It won't be settled out. And further, it may be requiring further reporting. It may be requiring further explanation. Clear with it? And further, the banks can be having their own policy related where the advance remittance or the remittance is up to the amount of 2 lakh USDs or lesser than that. In that particular scenario, the banks may be having their own policy for the same. And bill of entry is basically mandatory within a period of 3 months from the date of remittance, where the amount is exceeding 2 lakh USDs. It is the threshold limit for the same. And if it is not submitted by the importer in case the remittances exceed 2 lakh USDs within 3 months period, then the bank should be rigorously following up. And authorized dealer bank is also to forward a half yearly statement. A half yearly statement will be followed up with for the same. For which with there is default, right? And it's a half yearly statement. And after the half year, within 15 months, it is to be filed with the Reserve Bank of India in the form of BEF statement. We say such statement to be the BEF statement, right? So, imports of a company which is listed on the stock exchange, where the net worth is not less than 100 crores. We are talking about the import by the company. Now, if the goods have been imported, but those have been imported by the company, right? In that scenario, what is a limitation or what is a duty? Let's have a look at it. So evidence of import, particularly in that particular regard. So relaxation is applied to the companies like a listed company on a recognized stock exchange where the net worth is actually not less than 100 crore rupees, or net worth is basically as per the latest audited balance sheet, right? So both conditions are mandatory, that it should be a listed company and about the net worth should not be less than 100 crore rupees. So if these things are there in that particular scenario, the foreign exchange remitted, if it is lesser than 1 million USD or its equivalent per transaction, right? Or if the remittance is basically 1 million USD or above, normal documentary evidence is required. Normal documentary evidence is required basically in that scenario, right? If it is up to 1 million USD. Clear with it? Or other documents than the bill of entry, which can be basically be allowed. It's basically copy of bill of exchange, or it's a certificate from the CEO or the statutory auditor. Those are also permitted. So in case if it's a listed company and the net worth is not less than 100 crore rupees, authorized dealer bank may be accepting either the copy of bill of exchange or a certificate from the CEO or the statutory auditor of the company certifying that the goods for which the remittance was made have been imported into India, provided the foreign exchange remittance is up to 1 million USD. Is up to 1 million USD, right? In that particular scenario, this particular exemption is allowed. And you may also be asked about the IDPMS. Now, what is the full form of IDPMS? What is the full form of it? It is Import Data Processing and Monitoring System. Import Data Processing and Monitoring System. Right? So that is about it. Further after that, it's about the import finance. Very much important. It's about the import finance. Very much important. So we have already discussed about the letter of credit. So for importer, the letter of credit can be issued. The whole process I've already told you. It could be a site LC, or we say it to be DPLC. We say it to be DPLC. DPLC, or it could be a DALC. That is Usain's LC could be there, based on acceptance of the documents can be there. And that will be issued in the name of the, that will be opened in the name of the beneficiary abroad, right? Or it could be import loan. Import loan, like for the procuring the raw material for trading purposes, right? A loan can be issued, a loan can be sanctioned. Now that particular loan will be sanctioned on the security of the pledge of the goods or hypothecation, or to the financing bank. That can be allowed, right? And further, it's about the trade credit. Very much important. It's about the trade credit which can be allowed. It could be the supplier's credit, or it could be the buyer's credit. I told you that the import is to be completed within a period of 6 months. It is to be completed within a period of 6 months. And if it is not completed, in that scenario, we say it to be trade credit if it is up to the period of 3 years. If it is up to the period of 3 years. Now, what is the regulatory framework? The same regulatory framework, FEMA, is there. And what do you mean by supplier's credit? This topic is very much important. What is supplier's credit? Now, supplier's credit is a credit arrangement where the overseas supplier or the exporter that's going to extend the credit to the Indian importer. So we are having the Indian importer person A and overseas supplier person B. Overseas supplier has basically exported the goods here, and further that has given a credit line to person A. That's basically given a credit period to the person A, that you can be, person A can be making payment, let's say after 3 months. So credit period has been given, right? Let's say it may be the case of the letter of credit, or it may be the bank guarantee, so as to facilitate the transactions, those can be issued. But a credit which is applied by the overseas supplier to the Indian importer, that is the supplier's credit. That is the supplier's credit. And further, the exporter may avail finance against the bills. Now, when the bills are basically issued, so what will be done actually? B will be drawing the bills upon the importer, and bill will be accepted and will be given back to person B. Let's say it's a Usain's bill we are talking about, and a credit period of 3 months is basically allowed. Now, against these bills, the B, that is exporter, can be getting a credit by discounting these bills. By discounting these bills, the exporter can be getting the credit against these bills, but a credit will be available to the importer also. It will be available to the importer also, but exporter shall be liable to repay the bank in case overseas buyer does not make the payment, because it's on with recourse basis. So the discounting is mostly done on with recourse basis. Like the payment is to be, the payment will be made by the importer first of all to the exporter. But in case the importer denies or defaults, in that scenario, exporter is to make the payment to the bank. So any of the credit which is extended for up to the period of 3 years, which is basically extended up to the period of 3 years, that is the trade credit. And further, if it is beyond or equal to 3 years, then it is said to be the external commercial borrowing. So simply, it is basically allowed up to 6 months, but if it is greater than 6 months and it is up to 3 years, lesser than 3 years, we can say lesser than 3 years, then we say this to be trade credit. We say it to be trade credit. But if it is beyond 3 years, beyond equal to 3 years, or equal to 3 years, then we say it to be the ECB, that is external commercial borrowing. Clear with it? The second component here, it is the buyer's credit. The buyer's credit. Now, buyer's credit is basically arranged by the importer itself from the bank or institution outside the country, so as to settle the payment of the imports. Now, the buyer person B and seller person S. Seller has sold the goods to person B and B is to make the payment. Now, buyer will be arranging a credit from the, let's say, institution in the country of the exporter. There is an institution in the country of the exporter, and the B will be getting a fund from the B will be getting fund from the institution and will be paying the amount to the person S. That's basically the buyer's credit. So it is arranged by the buyer itself so as to settle the import payments. So as to settle the import payment, right? And further in India, if we are talking about the buyer's credit, as in the case of the supplier's credit, also is regulated by the exchange control guidelines. So what are the exchange control guidelines which are issued by the Reserve Bank of India? Those regulate the buyer's credit also. Those do basically regulate the buyer's credit also. Clear with it so far? Do confirm. And if you have understood the video so far, make sure to like this video and further share this video among your friends and colleagues who are preparing for the CAIIB exam. And I'm sharing the application link with you in the chat box from where you can download the application. It's available for the Android as well as for the iOS. And if you're iOS user, do use the ORG code GEGKT and start preparing for the same. And simply do WhatsApp CAIB to the number 83609 44207 so as to get all the details. The next one, it's about the factoring. It is said to be the account receivable factoring or the debtor financing. Like it's basically a method. It's basically a method where whatsoever the account receivables which are to be received by the exporter, those will be factored. Those will be factored. Those will be financed. So we are having three parties. One, it is related to client. The other one, it's related to the factor. And further, the third one, it's related to the debtors. Now the debtors are to make payment to the client. Let's say the client has exported the goods and further the debtors are now obligated so as to make the payment. And let's say a credit period of 3 months is allowed to them. Let's just assume that particular part that the credit period of 3 months is allowed. Now the client will be receiving the payment after the period of 3 months. And there is so much hassle related to managing the payments and further the presentation is to be of the document is to be done and everything is to be done like management of the debts is also to be done, right? Now client will be doing what? Client will be connecting with the factor and will be assigning these all sales, will be assigning these all credit sales to the factor. Now it will be the duty of the factor so as to deal with such debts, so as to deal with such debtors or account receivables. And further, the factor will be providing, let's say, 80 to 90% of the finance upfront. 80 to 90% payment will be done upfront. And further, now it will be the duty of the factor so as to manage the credit, so as to manage the debtors, right? Now, after the 3 months period, the factor will be connecting with the debtors and will be collecting the funds from the debtors. So that the whole process is said to be the factoring. The whole complete process is said to be the factoring. So factoring is actually what? Factoring is said to be the account receivable factoring, or we also say to be the debtor factoring, where the company or the client is going to sell the account receivables to the bank or financial institution, which we say to be the factor. Clear with it? And it was introduced in India in 1991. In 1991, it was introduced, and it was basically the Kalyan Sundaram committee, which basically submitted a report. Based upon that, the factoring was allowed. The factoring was allowed. And it is done for the short-term duration purposes. The factoring is done for short-term duration purposes, and it could be with recourse. With recourse. Now, what do you mean by with recourse? With recourse means in case the factor went to the debtors for the collection purposes, but the debtors defaulted, then the factor can be recovering the amount from the client. That's basically said to be the with recourse factoring. And when we say without recourse factoring or non-recourse factoring, one and same thing. Without recourse factoring or non-recourse factoring, in that scenario, in that particular scenario, if the factor is going to debtors and debtors fail to make the payment, it will be the duty of the factor only so as to recover the amount, and client cannot be asked for the payment purpose. And generally it is for domestic purposes, but it can also be used for the international purposes. It can also be used for the international purposes. The next topic, it's about the after the factoring. As I told you, under factoring, we are having three parties: debtor, that is a buyer of goods; client, that is seller of goods; and factor, that is financier. That is financier, right? And after that, we are having the topic related to the forfeiting. Now, where the factoring was for the short term period, the forfeiting is for the medium and the long term period. The forfeiting is for the medium and the long term period, and it is generally for non recourse basis, and it is for the international market, where in the factoring we were generally dealing in the domestic market. It can also be international, but generally we are dealing under the factoring for the domestic market. The forfeiting is for the international market. It is for the international market. Now let's have a pay attention to that particular fact. Let's say here we are having the exporter, right? And here we are having the importer. And let's say the exporter draw the bill on importer and accepted by the importer, and now that particular bill or receivable is available with the exporter. Now exporter will be connecting with the forfeiter, which will be a bank or the financial institution, which we say to be the forfeiter, right? Now let's say that the amount which is due is to be received in the medium term or in the long term period. Let's say for 3-year period or up to 10-year period, it is to be received, right? So it will be connecting with the forfeiter, and forfeiter will be connecting its correspondent part. Let's say it's bank ABC in the importer country, and they will be checking the credit worthiness of the importer, and everything will be made sure. And after confirming each and everything, the amount will be given, the liquidity will be given here. And in this scenario, it's not the case that 80% or 90% liquidity will be given in advance and rest of the payment will be made after the recovery. No, that's not the case in case of the forfeiting. In this scenario, 100% liquidity will be given after deducting their fees and interest whatsoever they are to charge. They will be providing the 100% liquidity to the exporter. That's it. Now the exporter's credit sale is actually converted to the cash sale, and the exporter is not to deal with the debt management. The exporter is not to deal with the failure of the importer, because generally it is on non recourse basis. And further, if there is any political risk, country risk, currency risk, that is not to be meant to be managed by the exporter now. So these are the benefits which are available under the forfeiting to the exporter. So it takes away the political and commercial risks, and 100% finance is available, and it is generally without recourse basis. Freedom from the credit administration. It is cost saving to the export credit insurances, right? And further, fixed rate financing is there. So freedom from the movement of interest rates and the tenor of the bill. So definitely it's very much beneficial. So that will be all related to the chapter that's facilities for the importers and exporters. And in the next video, we are going to start with the chapter number 6. Make sure to watch the complete series of the BFM, because this complete series is going to help you a lot, because in BFM, module A and module B are the most important modules. Module B we have already covered in complete, right? And now we are covering the module A. Half of the module A is just done, and we are left with the 5 other chapters. So make sure to watch the videos on daily basis. We are having the classes from Monday to Saturday on daily basis, except the Thursday. So tomorrow it's Thursday, so tomorrow there will be no session, and we'll be commencing the session now on Friday and Saturday, right? So thank you so much, and see you again in the next video.